Hey everyone, Ray here from Nest Mortgage, and I hope you're having a great week and a busy week it has been in economics news, starting with Statistics Canada's Tuesday release of February inflation numbers. We know January CPI clocked in at 5.9%, and Tuesday we tipped the scales for February at 5.2%. So that downward trend continues, which is something that's more than welcome and that the Bank of Canada wants to see. We know the bank is on a conditional pause right now. Their belief is that the missing ingredient here is time, not necessarily more rate increases. But the biggest thing that has the potential to knock them off that pause is what their counterparts down south do with their monetary policy. So the US Federal Reserve Board's announcement yesterday was something that was going to be closely monitored. What they do with their rate does have a big impact on what the Bank of Canada decides to do. And it came in softer than what was expected just 2 weeks ago. We were looking at potentially a 0.5 point increase. Instead, we get a 1/4 point and a much softer tone. They didn't go so far as to make a conditional pause like the Bank of Canada has done, but they certainly took a step towards that from what the narrative was 2 weeks ago. And the biggest culprit for that is the collapse of Silicon Valley Bank and Signature Bank and the stress in the banking system in general. There is a saying that goes, when the Fed slams on the brakes, somebody goes through the windshield. And with those banks effectively going through the windshield, the question has become, well, who else isn't wearing their seatbelt? So they're taking a little bit more of a cautious approach now as things start to break. They don't want to over tighten and cause more damage than is necessary. So the dialogue and tone has shifted to be a lot more soft. Now, as a result of that, we've seen fixed rate pressure across the board come down. Bond yields in 2, 3, 4, 5-year terms have all come down, which is making those shorter term fixed rates potentially more attractive to variable rate borrowers who are maybe suffering from a little bit of variable rate PTSD over the last year. Now, there is a trade-off with all these decisions because a variable rate will eventually come down as well. I do believe the next move for the Bank of Canada is downwards. That will be in 2023, but not necessarily at their next meeting. So that's something that I think is probably a little bit more forward-looking. So by moving to a fixed rate, you're potentially leaving some savings on the table down the road. However, there is some stability and safety in those shorter-term fixed rates. So if that is a situation you're in and wondering what to do next, by all means, reach out. We'd be happy to take a look at those options and talk you through them. Take care out there.